Imagine you're at an airport terminal, waiting for your flight. You glance at the departure board, those little bars and lines that give you a quick visual summary of incoming flights. Now, what if I told you there's something similar in the stock market called a candlestick chart? These charts aren't just a fancy way of displaying data. They're like those airport boards, giving us crucial information at a glance. So, here's the question: what does a candlestick chart actually show? The first thing to understand is that these candlesticks are like weather reports for the stock market. Each bar represents a period of time, minutes, hours, or even days, and tells you two things: where the price opened and closed during that time frame. Here's how it works. Think of each candlestick as a little house. The body of the house is the part in the middle, representing the opening and closing prices. If the stock price closed higher than it opened, we paint the walls green or white, signifying an upward movement. On the other hand, if the price closed lower, we color the walls red or black, indicating a downward move. And here's the surprising part. By looking at how long the body of these houses are, you can see how much the stock moved during that period. A tall candlestick means there was significant movement, while a short one tells us the price barely changed. So, next time you come across a candlestick chart, remember it's just another way to read the market's heartbeat. Quick and easily understandable. Okay, so now that we know what a candlestick chart is all about, those little stick figures with candles on top or bottom, it's time to dig deeper into their components. A candlestick chart isn't just a fancy drawing. It's like a snapshot of the market's behavior over a specific period. Let's break down the four main parts: open, high, low, and close. The open is pretty straightforward. It shows us the price at which an asset started trading for that particular session or time frame. Imagine you're watching a movie scene by scene. Each candle represents one of those scenes. The opening price is like the first frame of each scene. It tells us where we start. And here's the surprising part: the high and low. These are the peaks and valleys within that session. If you imagine an asset's price as a roller coaster, the high is the highest point the coaster goes up to, while the low is the lowest point it reaches. For example, if Bitcoin had a price of $40,000 at its start of the day, but reached $42,000 during the trading session and then settled back down to $39,500 by the end, those would be your high, open, and close prices for that day. The low here would be around the initial price or the lowest price it hit during the day. The close is like the final frame of each scene in our movie analogy. It shows us where a session ends and tells us the last official price at which an asset traded before the market closed for that period. If Bitcoin ended up trading at $39,500 by the close of the session, then $39,500 is your closing price. Now let's put it all together. Each candlestick represents a day's worth of this action: how high prices went, how low they dipped, and where things settled in the end. The body of the candle, the rectangle part, shows you the open and close for that session, while those little lines above and below, called shadows or wicks, tell you about the highs and lows within it. So there you have it, a full breakdown of what each component means. And here's the key takeaway. These four elements together paint a vivid picture of market behavior over time. They help us understand not just where prices are now, but also how they got there. All right, so far we've broken down the basic components of a candlestick chart. Now let's dive into the third key aspect: understanding different types of candlesticks and how they can signal potential reversals or continuations in market trends. Imagine you're looking at a candlestick chart like it's a weather map for the financial markets. Each candle is like a tiny snapshot, showing us both the high and low prices of an asset over a certain period. But there's more to these candles than meets the eye. They can tell us about potential shifts in market sentiment. The first type of candlestick we'll talk about are hammers and shooting stars. These patterns look surprisingly like their namesakes, like tiny hammers or inverted shooting stars hanging out on your chart. Hammer. This is a bullish pattern, often seen at the bottom of a downtrend. A hammer has a long lower shadow and a small body near the top, indicating that after a period of selling pressure, buyers step in to push prices up. It's like finding a little bit of sunshine amidst the clouds, signaling that the market might be turning around. Shooting star. This is its bearish counterpart. A shooting star has a long upper shadow and a small body near the bottom, suggesting that after an uptrend, sellers are pushing prices down very quickly. It's like seeing a meteor streak across the sky, sudden and powerful, indicating that the market might be about to drop. The next pattern we need to understand is the engulfing pattern. This one can signal a continuation or reversal in trend, depending on how it plays out. There are two types. Bearish engulfing, when a small bearish candle, red, is completely engulfed by a larger bearish candle that follows. It's like a wolf swallowing its prey, indicating strong selling pressure and suggesting the market might continue to fall. Bullish engulfing, conversely, when a small bullish candle, green, is completely engulfed by a larger bullish candle that follows. It suggests the bulls are back in charge and prices could start rising again. It's like seeing a group of defenders holding off an attack, indicating strength from buyers. These patterns might seem simple, but they can be incredibly powerful tools for traders to identify potential reversals or continuations in market trends. And here's the surprising part. Their effectiveness isn't just limited to candlestick charts. These same patterns show up in other technical analyses and even in everyday life. All right, now that you understand how candlestick patterns are built from each price tick over a certain period, let's dive into something even more crucial: time frames and context. Think of it like watching the same event through different telescopes. Imagine you're at a busy train station and you look through 3 different telescopes, one wide angle, one medium range, and one zoomed in so tight you can see individual faces. The same scene looks vastly different depending on which telescope you use. That's exactly what time frames do for candlestick charts. And here's the surprising part. A candlestick chart that shows 1 minute of trading action is telling an entirely different story compared to a daily or weekly chart. Let's take a closer look. If you're looking at a daily chart, it's like zooming out to see the overall weather patterns over several days. You can spot trends and support/resistance levels that appear in those larger time frames. But if you switch to a weekly chart, suddenly your view changes. You might notice that what looked like a strong uptrend on daily charts is just a consolidation pattern. The big picture becomes clearer, like seeing the clouds part after a stormy day. So why does this matter for traders and investors? Well, it's all about context. A bullish candlestick might look promising in a short time frame, but could be part of a broader downtrend when viewed over weeks or months. For example, let's say you see a series of green candles on your 5-minute chart. That might make you feel excited about the momentum. But if that same pattern occurs within a larger weekly downtrend, it's less likely to signal an actual reversal. Let's use Bitcoin as an example. On a daily chart, you might see a strong bearish trend. However, when you zoom into the 1-hour chart, you notice some green candles appearing frequently. This could indicate that within that larger downtrend, there are short-term buying opportunities. Understanding time frames helps you filter out noise and focus on meaningful patterns. It's like knowing whether to bring an umbrella or a coat based on whether it's raining outside or just drizzling. So remember, the time frame of your candlestick chart shapes its story. A pattern that looks significant in one time frame might be just a blip in another. Always consider the bigger picture and how different time frames interact. By doing this, you're getting closer to understanding what a candlestick chart actually shows. Every tick is not just data, but a piece of a much larger puzzle. So, we've broken down candlestick charts into their components: time frames, context, and individual candles. Now, let's put it all together. Imagine you're trying to predict the weather. You look at your local forecast, but you also check the satellite map, the radar system, and even ask a meteorologist for their expert opinion. Each source gives you different information, but when they all point in the same direction, that's when you know it's time to grab an umbrella. In candlestick charting, it's similar. You have your daily candles giving you today's weather report. Then you look at weekly and monthly charts for a bigger picture. Where is the general climate heading? And here's the key. Combining these different pieces gives you a more complete understanding of what's happening in the market. Now, imagine you're looking at multiple time frames. You see daily candles showing some volatility, but weekly and monthly charts are trending upwards. This is like finding out that while it's raining today, there's actually a heat wave building up. You need to look for confirmation across these different time frames to be sure. Let's say you're analyzing an ETF, exchange-traded fund, on a daily chart and see a bearish signal, a long red candle indicating the price is dropping. But then, when you zoom out to the monthly chart, you notice a steady uptrend over several months. This is like seeing signs of rain every day, but looking at the bigger picture, you realize it's just part of an ongoing drought. By studying candlestick charts across different time frames and confirming patterns, traders can build stronger conclusions about market trends. It's like using multiple maps to navigate an unfamiliar city. If one map shows a road closed, but another shows a detour that works, you have a better chance of reaching your destination smoothly. So, when you see a candle on a daily chart, it tells you what the weather is today. But if you also see confirmation from weekly and monthly charts, like multiple maps pointing to the same route, that's when you can be more confident about making informed decisions in the market. And here's the surprising part. Sometimes, the most valuable insights come from looking at these different perspectives together. It's like having a weather station that combines satellite data with ground-level readings. It gives you a fuller picture and increases your confidence in what to expect. And there we have it, candlestick charts decoded. You now know that those little bars are telling us a story about price movements over time. The body of each candle shows the opening and closing prices, while the wick, or shadow, tells us the high and low points during that session. So, when you see a long upper wick but no lower one, it means the stock or currency struggled to break above its previous high. Now that you understand what those candles are saying, you can start applying this knowledge to your own market analysis. When you look at a candlestick chart, you'll be able to spot trends and patterns much more easily. Maybe you notice clusters of short, bearish candles. Those could signal a potential reversal. Or perhaps you see long, bullish candles with little wicks, suggesting strong buying pressure. The third one surprises everyone. Understanding candlestick charts can give you an edge in making informed decisions about where the market may be headed next. It's like having a secret decoder ring for the financial world. So if you'll never look at a plane the same way after decoding its blueprints, imagine how much clearer the markets will seem now that you've decoded their language. Subscribe to our channel so we can continue to dive into these fascinating topics together and uncover even more insights. Together, we can navigate the market with confidence.